Well, certainly as we get into 2026, we will be trading at high valuations with high earnings expectations. You've seen valuations just that last week. They got over 23 times forward earnings. You have earnings expectations for mid-teens growth that's baked in already into S&P 500 estimates. And so that does create a high bar for the market to jump over. And I think the question will be is there further upside to earnings estimates because of things like AI productivity and AI investment? I think that remains a big question mark. And B, and this is a little bit nebulous, which is, do you still have a liquidity environment that supports even more margin or multiple expansion? Because if liquidity starts to recede, then 23 times looks pretty darn expensive.
Particularly with the Mag 7, still putting up some big numbers, but the growth rates are decelerating for the Mag 7. So that means the 493 need to really perform. How do you think about that?
Hope springs eternal in the broadening out trade. That was something that market participants were hoping for in 2025. This idea that you would see the 493 catch up even as Mag 7 decelerated. And what ended up happening is Mag 7 surprised to the upside and 493 surprised to the downside. And you didn't see that kind of catch up. But if we look at what's going on in 26, you have this law of large numbers that's pulling Mag 7 earnings growth lower. And of course, second derivatives matter in markets. So you have a name like Meta decelerating from 40% growth this year to a potential decline of about 2% next year. And you see that across the Mag 7 names. And this baking in of the idea of the broadening out really relies on the economy, A, being very strong, and B, these businesses being able to generate margin expansion. And they don't necessarily deserve the benefit of the doubt as we look at that 493 because they've continuously underperformed or disappointed on the earnings front over the last few years.
What are you looking at outside the AI trade? Because there's a lot of good stuff out there that we just don't talk a lot about because it doesn't garner the headlines.
Yeah, our equity portfolio manager, Jay Peters, has been absolutely salivating at some of the deals that he's starting to see where you have had names simply get left behind in the rally. Remember that September and October have been incredibly low quality rallies and incredibly narrow rallies. So a lot of junk moving higher very, very fast. And then the quality things that have been moving higher have really just been in that Mag 7. So if you can broaden out the aperture into more value-oriented names as well as mid-cap names is where we're finding a lot of opportunities of parts of the market, again, that have just simply been left behind, but remaining very disciplined on those quality metrics, not chasing the junk, not chasing the dumpster dives, I think is incredibly important at this time.
The most powerful leadership in this market over the last 6 months has been low quality, junky, no profit, no revenue, speculative parts of the market. That reminds me in 1998, 1999, early parts of 2000s, the stuff I was selling when I was a banker. How concerned are you about that?
Yeah, it's been something that has definitely caused us to raise an eyebrow. We wrote about it over the weekend saying this is not sustainable. We looked at the rally that you saw in, for example, Korean fried chicken stocks in response
Korean fried chicken
There was a picture of Jensen Huang eating fried chicken.
Right. It went viral.
And you saw this big, huge surge in Korean stocks. But if you look at the Kospi, it rallied 26% in October alone. So
Talk about irrational exuberance.
Exactly. And the Kospi has oftentimes had these kind of casino capitalism types of moves. So it's a global dynamic. And why we remain really disciplined about quality is because what tends to happen is these names can go up a lot in a very short period of time, but they can also go down a lot in a short period of time. So from a portfolio perspective, they actually don't add any incremental return. And at the same time, they just add to volatility.